Hello, I'm Richard Parfect, and I look after specialist assets research within MGIM. Within that, I cover the property space via a selection of REITs. Our strategy is to find high-quality asset management teams that have a demonstrable track record of buying, asset managing, and then, as valuations increase, potentially exiting properties to reinvest the capital into other areas. In recent years, we have targeted teams that are active in one or more of the generically termed beds, meds, sheds, and breads space. To do this successfully requires a highly informed, experienced, and engaged team with the emotional maturity to not become wedded to specific assets. LondonMetric is an internally managed REIT with an excellent track record of targeting the subsectors within property that offer the best opportunity for future returns. They are not wedded to any particular sector, and indeed, since we have held the shares, they have reduced exposure to some sectors to be early movers into the industrial and logistics space in the UK. This strategy has enabled investors to benefit from asset value growth and dividend progression before and during the COVID pandemic. I'm pleased to introduce to you Andrew Jones, the CEO of LondonMetric, with whom I have had many insightful meetings over the years, discussing not just LondonMetric itself, but the property market in general, particularly as he is never afraid of being contrarian. Over to you, Andrew.
Hello, ladies and gentlemen. My name, for those of you who don't know me, my name is Andrew Jones. I'm the Chief Executive and co-founder of LondonMetric Property. This morning, I'm going to talk you through my thoughts on the real estate market. I'm then going to go on to talk about our highest conviction core, which is the logistics sector, and go through that in a deeper dive. And then go on to give you a little bit more information and backdrop about LondonMetric, its history, an overview of the company, where we sit today, and also the activity that we hope to execute in the future. And then I'm going to finish off with a look forward slide with our thoughts about where the real estate market's going and the sectors that we want to continue to allocate capital into. So without further ado, I'm going to just go on to talk about the structural forces that we're all living with today, which continue to have an impact on real estate. The fact of the matter is we've obviously lived through an incredibly difficult period, arguably unprecedented period, over the last 18 months or so, and that has accelerated a number of these forces, trends, and consequently they are having a profound and in many cases permanent impact on various real estate subsectors. The fact of the matter is, technology continues to impact how we work, shop, and socialise. And as you can see there, there are companies that didn't exist 5 or 10 years ago that are now very much part of our everyday lives. Whether or not it's Airbnb in hospitality, flexible working providers such as WeWork and IWG. In transport, it's Uber, Lyft, Wheelie. And more recently, in retail, disruption that initially started with Amazon, a decade or so ago in the United Kingdom, now being joined by a number of what we call the rapid delivery grocery companies such as Getir and Gorilla. And obviously, in the restaurant trade, disruptions coming in the form of Deliveroo, Just Eats, and obviously Uber Eats. Also worth probably pointing out that we which obviously you're already aware of, is that we do live in a world of zero interest rates, negligible bond yields, and in many cases melting dividends. And there is therefore an almost desperate search for income. Interest rates. Everybody tells me that interest rates are going to rise, but nobody can tell me when. They've been telling me they're going to rise for at least the last 10 years since we started to come out of the impact of the GFC. And together with that scene is also exacerbated by the fact that we are living in a, like often referred to as the beginning of a demographic tsunami, where people are getting older, they're living longer, and therefore their need for income is indeed growing. And we think that the right real estate in the right structurally supported subsectors is a phenomenal investment opportunity for some of these investors. And I'll come on to talk about that in a little bit more detail later. And then finally, we talk about urbanisation. Certainly in the commercial world, there's a continuing increased competition for space. The fact of the matter is, we as a population, our expectations and our aspirations grow every single day. A couple of years ago, we might have ordered something online and been happy with a 3 or 4, 5 day delivery slot. Now we're expecting it in, 3, 4, 5 hours. And therefore, that is changing the makeup of demand for real estate close to where people live and work. And that's something that will continue to drive our own thoughts around where we want to allocate our capital within the United Kingdom. The fact of the matter is the UK as a population, we've embraced internet shopping probably more than any other population or any other country in the world. Our penetration is higher than almost anybody else. And as I said to an investor recently, if internet shopping was an Olympic sport, then we would be on the podium. As a result of some of those structural changes, what we have seen in the UK real estate market has been an increasing polarisation of performances. The gap between the winners and losers has never been bigger. And as you can see on the chart on the right-hand side there, back in 2016, the gap was around about 700 basis points between the best performing subsector and the worst performing subsector. Last year, that gap was 3,800 basis points. The fact of the matter is, the winners are being unmasked and are going to win by a greater degree, greater amount of victory, whereas the losers continue to see value erosion, and that is something that we can expect to continue. The fact of the matter is, sheds, beds, breads and meds, for want of a better description, are going to be the standout performers. We think shopping centres will continue to see value erosion as rents continually reset as a result of consumer shopping patterns changing and the demand for physical space dropping. Retail parks, proving that not all retail is the same. Retail parks, we think, will be more resilient, simply because they offer a degree of convenience that means that they can, operators can dovetail their physical presence on a retail park with their online offer more seamlessly than they can in a shopping centre, and therefore you get a true omni-channel operation. And I think that if you look back over the last 18 months across the retail piece, department stores and what we refer to internally as apparel retailing has been very, very tough. Very, very tough. And that's what dominates shopping centres. Conversely, in retail parks, a lot of the retail parks are dominated by DIY. They're dominated by the discounters such as B&M, convenience groceries, the Aldis, the Lidls, home and electricals. Those sectors have done very, very well. Oh, I've also got to add pets in. And those are your traditional retail park tenants. And so therefore they have had a very strong 18 months. They have all had actually a very good COVID. Unlike the department stores and the apparel and fashion retailers that dominate the shopping centres. And then finally, the office sector. I mean, we have very, very little office assets and very little office experience, but we do think about the office outlook as being uncertain. And I think it's very difficult to predict, as the work from home, continues to disrupt occupancy. And I don't think we're going to get any clarity from that for a number of years. And then finally, the other macro trend that is going to impact sectorial performances is, as I touched on already, is the fact that we live in a world of very, very low interest rates and bond yields. And I think that will see an increasing amount of new investor demand for well-let real estate assets in the right structurally supported sectors that deliver that reliable, predictable, and hopefully growing income stream, which is very, very difficult to get elsewhere in that low interest rate world that we live in today. We often refer to it as TINA. There is no alternative. So just a little bit of the investment backdrop of where the real estate market is today. It's been through, the real estate market traditionally goes through various cycles. So if I think back to as we came out of the global financial crisis, the fact of the matter is, with the benefit of hindsight, we should have bought any asset in any sector. The fact of the matter is, buy the market. Yields were at attractive levels, and in the subsequent years, what we have seen obviously is yield compression, and therefore all boats have risen on that particular tide. However, then back in 2015-16, we as a business began to look at the various subsectors, and I'll come on to talk about this because it's relevant to how the LondonMetric portfolio has evolved over the last 8 years or so. We started to look at the sectors and trying to identify what we think were going to be the winning sectors. And those were the ones that were going to be structurally supported by the macro trends that were taking place in the wider world. And I talked about it before about, it's sheds, beds, breads and meds. And for us, that continued to frame our thought process from 2015 onwards. And that's what drove our big investments, certainly into the logistics market, but also into the convenience grocery market as well. And then more recently, we've continued to focus or spent more time thinking about not only being in the right sector now, but also wanting to own the right assets within that sector. And that for us has seen us sell out of some of our logistics investments that we purchased back in 2013, 2014, 2015, where we've enjoyed some rental growth, but material yield compression. And today we think that yields for logistics assets are quite low, and therefore if that is a sustainable metric, therefore it needs to be supported by good rental growth. And our view is that rental growth across the logistics market will not be completely uniform, and therefore returns will be increasingly dictated by the quality of the asset, the geography, the quality of the tenant, the occupational contentment, the weighted unexpired lease term. And putting all of that together will hopefully give us that ability for superior rental growth that supports the cap rate that we're seeing today in the market. Taking a step back on my next slide, the logistics market, looking at at a holistic level, you've seen a lot of money coming into this sector. Not surprisingly, it's a winning sector in a market that is increasingly polarizing. So as an investor, you've got to run your winners and sell your losers. As a result, we've seen strong performances both from a capital value perspective. You see there year-to-date values are up 11%. Huge amount of investment coming in. 6 billion of demand for investment transactions in H1 this year compares to 8 billion in the whole of 2020. And the fact of the matter is there are a lot of people wanting to get into this market, and there is a little bit of a FOMO, and a fear of missing out. And that investor demand is both UK, Far East, American, and we've had a terrific insight into the amount of money chasing this market. We recently sold one of our Primark logistics warehouses in Northamptonshire for 102 million to a US investor, yield of around about 4%. That is an asset that we bought for 60 million back in 2013. And all we've done is collect the rent, settle a couple of rent reviews, and enjoyed the yield compression over that subsequent 8 years. And then occupationally, demand for warehouse space is very strong across virtually the whole of the United Kingdom, helped by a lot of occupiers needing to get fit for purpose, needing to overhaul their logistics infrastructure. Some demand has come out of COVID. There's been a restocking taking place, and I think that has you've seen a big increase in demand over the last 12-18 months or so. The H1 take-up for 2021 is at 20 million. And 20 million would be round about where we'd expect a full 12-month take-up to be. What is interesting, though, as you can see on the right-hand side there of the slide, is the fact that 41% of that demand is coming from online retail. Arguably that was not a sector 5, 6, 7 years ago. 41% of the demand is fresh demand. And that is obviously helping the demand-supply dynamics. It's in turn going to lead to superior rental growth. So the online penetration, as that online penetration in the United Kingdom continues to grow, that does require more warehouse space. It's probably worth pointing out that £1 billion worth of sales that go through a physical store network traditionally would require about 450,000 square feet of space. £1 billion worth of sales that go through an online channel will require about 1.2 million square feet of logistics space. And that's because the online channel offering needs to account for a greater inventory, deeper inventory. They tend to offer much wider ranges. And finally, they need to deal with reverse logistics, the number of returns that we have to send back. And that, as a result, so as we requires a greater footprint of warehouse capacity, and so therefore, as we see more sales shifting from physical to online, definitionally that will drive further demand for warehouse space. I also think that there will be increased demand from a number of operators who look at moving away from just-in-time logistics strategies to just-in-case. The fact of the matter is, there's been a lot of uncertainty and disruption in global trade over the last 18, 24 months, and that might be geopolitical. Brexit has caused its issues. Obviously COVID has had a material impact, but so has things, what we refer to internally as the black swan event. Nobody foresaw that a tanker could close the Suez Canal for a week and the impact that has. And so therefore, I think a number of businesses will increasingly look at their inventory that they hold on the island of Great Britain and maybe decide that we actually need a deeper inventory for certain items, and therefore also I think could lead to more demand. And then finally, on the supply side, when you see excessive demand, you expect in the property industry for the supply to react to it, and it generally will do. It's more difficult in logistics, particularly in regional and urban logistics, because the land isn't there. And the fact of the matter is, urban land, has higher values for almost any other use apart from logistics. Whether or not it's, build to rent, whether or not it's student accommodation, retail, office, hotels. The fact of the matter is, the rental value and the counter values of logistics assets is the bottom of that list, and therefore, finding new land in urban locations for new supply is extremely difficult. And therefore, that's why I think that that is why urban logistics is our strongest conviction call. Some of those traits also exist in the regional logistics market, probably not to the same degree, but they still exist. And there are also constraints in the mega shed market. The big box market does have some supply restraints, but they are not going to be as great as the supply constraints that you get in the urban market. So when you put those together, you get superior rental growth. You have excess demand, you have finite supply, you have superior rental growth. And as you can see there on the slide on the left-hand side, over the last 10, 11 years or so, you've seen better market rental growth in the logistics sector, I suspect, than anywhere else. The slide on the right-hand side is actually our own experience, and this is not hypothetical rental growth. These are actual rent reviews that we have settled, either through open market negotiations or through contractual rental uplifts that we have within our various leases. And as you can see there, those are the rent reviews that we've done, settled over for during our last financial year. And urban logistics is obviously the standout performer there, as you can see. But again, very strong performance coming from our regional assets as well. And mega, whilst it's not as strong as the other two, it's still positive. And there aren't many sectors that you can say that about. And I think so. This is real live data. We continue to populate this slide every time we settle another rent review. And that's information that we'll continue to share, with our investors during our half year and full year presentations. And also what we are continuing to do is to analyse why, within the various subsectors, why certain geographies are performing better than others. And is it because of the fact that the southeast is going to perform better than the northeast, or is London going to outperform Birmingham? So we're still that's work in progress, but it's something that we will continue to investigate and interrogate so that it can again fine tune our capital allocation decisions. So a little bit of backdrop on LondonMetric for those who don't know us. LondonMetric was formed through the merger of Metric Property PLC and London and Stamford PLC back in the first quarter of 2013. Today we are a REIT. We are a REIT by definition, but we also are a REIT in the way we think and operate. We have a £2.6 billion portfolio come on to talk about that in a bit more detail on the subsequent slides. But the portfolio has gone through an enormous change since our merger 8 years ago. As I say, we've taken advantage of the structural shifts that have taken place and tried to align our real estate assets towards those. In keeping with our REIT approach, our objective is to deliver a reliable, repetitive and growing income, because we believe that is how we can give you superior investment returns. And we pride ourselves on our progressive and covered dividend. And our aspirations are in time to become a dividend aristocrat. I mean, we've got a number of years to go before we achieve that accolade, but it's something that is firmly in our sights. And then I should just also say that I'm as I said at the introduction, I'm co-founder of this company, and as a result, myself and my fellow directors have a strong alignment of interest. It is an internally managed, and we are all employees, but we are shareholders first. And that affects how we our decision. We are eating our own cooking. I think combined management are now the 8th largest shareholder. And so, we're on exactly the same side of the page as all of our other investors. There are no conflicts of interest. We stand shoulder to shoulder with all of our investors. And the fact of the matter is it helps frame our thought process and our decision making. And, and as I often say, I think that it's a powerful message to send out, because I do believe that capital, we will attract capital if we treat it correctly, and that is something that we think about deeply. So then a little bit more into how the LondonMetric portfolio has evolved over those 8 years. As you can see, back at the time of our merger in 2013. Eclectic mix of London assets, both residential and office. A quarter of the asset base was in retail parks, and about 21% was in the distribution sector. Fast forward 8 years, we now have 72% of our assets in the distribution centre, predominantly urban, which I've talked about, but also regional and mega investments. I'll come on to talk about those 3 subsectors in subsequent slides. But we've also grown our, what we often refer to as our long income portfolio, which is dominated by grocery, convenience, and also triple net retail. And again, I'll come on to talk about those assets in a little bit more detail later in the presentation. And then there are 2 small cheeses in grey there, light grey and dark grey, which is our retail parks exposure. I think we've got, this slide shows us with 3 retail parks. We've subsequently sold one in Leeds, so that number, that 2.8% will fall. And then other is the offices, our non-core offices that we're in the process of divesting. The portfolio characterised by long leases, high occupancy, and as you can see there, over half of the rent is subject to some form of indexation, whether or not it's a fixed uplift, a defined fixed uplift, or whether or not it's CPI, or whether or not it's RPI, and that's something that gives us the guarantee of income growth. I said I would drill down into the logistics portfolio in a bit more detail. We define these into 3 silos: urban logistics, which would be 100,000 square foot and below, located close to where people live and work. This is a £1 billion portfolio today, arguably from a standing start 4 years ago. It is our strongest conviction call, simply because of the attractive demand-supply dynamics that we're witnessing and the superior rental growth that we're collecting. We have over 100 assets, high occupancy, and a weighted average unexpired lease term there of 8 years, which is slowly creeping up. But I think it's if you look at the rental growth that we secured over the last 3 years, we're talking here around rental growth of between, I talk about it, round about 4%, give or take. Last year, the rent reviews we settled delivered 3% per annum. Over a 3-year period, it's just over 4% per annum, and that's why it's one of our strongest conviction calls. Regional, that's a £500 million portfolio across 11 assets, long average weighted unexpired lease terms, full occupancy, and again, some strong rental growth metrics there of between 3 and 4%. So, and then our mega portfolio, which amounts to it's 3 assets, just over 350 million. That would have reduced by roughly 100 million following the sale, or when the sale completes, of the Primark distribution investment that I touched on earlier. Very long lease terms, 15 years, full occupancy, and all of the rents here are subject to contractual uplifts, whether or not it's fixed uplifts or CPIs. And as you can see there, positive 1.5% per annum. Our long income portfolio, as I touched on earlier, dominated by our grocery and roadside investments, let to people like Aldi, Lidl, more recently Waitrose, but also companies like Co-op and M&S, Simply Food. And this is convenience groceries, either standalone with its own car park, or convenience groceries sitting on petrol service stations, where we believe that is that it operates more as a convenience grocery offer than it necessarily does to a fuel, to supply fuel. And that's something that we have very strong views on, and how that petrol market evolves. The fact of the matter is, I don't mind if they're selling petrol, hydrogen, water, gas, diesel, or electricity out of those pumps. It really doesn't bother me. What I do know is that actually, whilst there's a halo spend that's going to take place whilst people are doing those tasks, and that tends to be going in, getting a coffee, buying a top-up grocery food, and that's something that that market, we think, is something that's going to evolve as consumer trends continue to shift. Our triple net retail investments are dominated by the discounters, the B&M, the Home Bargains, the Range, for those of you who are familiar with those brands, because not all of them are listed, but also our furniture investments with DFS and Dunelm, but also some electrical exposure with Currys, PC World, and, as I touched on earlier, Pets at Home as well. And that sector has been out of favour. It's had a very, very strong 12 months, and it will continue to have a very strong 12 months, because investors are continually attracted, to the high initial yield. You can see it there, 6.5%, 10-year weighted average unexpired lease term. And also, all of those operators, unlike the department store operators I touched on earlier, and unlike the apparel retailers, have had a very, very strong period. And then our trade and DIY exposure tends to be dominated by our investments with Wix, but also with Jewson's, Selco in particular. Again, this is a sector that's benefited enormously from the work from home over the last 18 months. And the fact of the matter is, the more time we've been spending at our homes, the more money we've been spending on our homes. And so this is a sector that we would like to grow our exposure to, subject to finding the right opportunities. And then finally, we have a small leisure exposure, which is about 2% of the overall portfolio, dominated by 4 Odeon cinemas, which obviously had a tough time over the last 18 months. We think we can see a way out for the cinema market. I mean, I wouldn't say that we were 100% confident about it, but it's something that we are well connected. We have a great relationship with Odeon. We've worked with them over the last 18 months to help them get through this difficult period. We think, as I say, we can see some light at the end of the tunnel, but again, time will tell. But as a portfolio, the long income portfolio has excellent credits. It's long indexed leases. We're benefiting, I think, from evolving consumer trends, and we live off an attractive nearly 5.5% net initial yield. We have 14 years unexpired lease terms. We have 100% occupancy, and nearly 2/3 of that income is subject to some form of contractual uplift. And I think that's something that is in the direct property market, we are seeing a lot of investor interest in that, so we expect those yields to compress. I mean, no presentation would be complete without touching on our ESG activity. It's something that we take very, very seriously, and like probably nearly all companies that present to you today, the focus of our activity on this this area has intensified over the last few years, and it will increasingly frame our investment decisions, because I think it will increasingly frame the pricing of real estate assets. The fact of the matter is, I think that if you don't embrace what's going, this evolution, you're going to find out that you're holding some assets that look like melting ice cubes, and that the liquidity for some of these poorer buildings will fall, and price will take the pain. So this is something that has had a huge amount of attention and focus from us at all levels throughout the organisation over the last 3 or 4 years. and we're not where we want to be, but we're a long way from where we were. And our focus is to continue to build the portfolio around assets that have the EPC ratings A, B, and C, preferably A and B, but A, B, and C, and looking at investments, new investments. I'm happy to buy investments that don't meet those criteria, but knowing that I'm capable of, through our skills and through our capital, I'm capable of reinventing those buildings so that I actually can bring them back into economic use. And that's something that we pride ourselves in. It's something that we have a great skill set in doing, but we also have the capital to do it. The easiest thing in the world for me is to sell assets that aren't in A, B, and C and pass the problem down the line to somebody else. We are great stewards of those buildings because we have the skill set, we have the experience, and we have the capital in order to bring a lot of these, maybe redundant, inefficient buildings back into true economic use. And that's something that will continue, as I say, continue to frame how we think about existing assets, what we want to do with them, but also how we frame what assets we want, where we want to deploy new capital into. So just a quick look back on our performance over the last few years from a portfolio and also from a shareholder perspective. We continue to grow our net rental income. It's very important to us. We think, as I said before, income is an important contribution to our total property return. It's what's driven our earnings per share. Our earnings per share, back at the time of our merger, I think was 4.2p. You can see there on the slide now we're up at over 9 pence. So that repositioning the portfolio, pivoting the assets into the right sectors has allowed us to also capture some fantastic earnings growth. And not surprisingly, that's delivered strong property returns, because we've been in the right sectors and we've got the right skill set, I think, to maximise returns from those assets. And that in turn has allowed us to deliver, some strong total shareholder returns. And that's a combination of not only share price appreciation, but also, the importance and the weight that we put behind a growing and covered dividend, and the reinvestment of that, the compounding impact of it is there for you to see on the bar chart on the right hand side. So finally, on my last slide, I'll look forward, our thoughts on the industry and how we're going to approach the capital that we have invested within LondonMetric. We often refer to this slide as the 4Ds. Digital disruption. We think that the macro themes will continue to play out, and we think aligning your real estate portfolio to those macro themes is likely to ensure that you're on the right side of the curve. Hoping, as some management teams no doubt do, that we go back to where we were in 2019 is not a strategy. The fact of the matter is the world has changed, the tectonic plates have shifted. Online retailing, has accelerated to, over 30%. And whilst that 30%, it's up, it'll probably drop back a bit as we get back to full reopening, hopefully in the autumn and the winter. It's not going back to the 19% it was back in February 2020. And that, a lot of temporary behaviours, for all of us, increasingly going to become permanent, and that goes for lots of aspects of our how working and social lives. The second D is demographics. I touched on a demographic tsunami. People are going to be living longer. There's almost desperate search for income, and I think we are actually seeing this even today. And since the start of the calendar year, the number of investors coming into the sector, looking for maybe shying away from low yielding securities and looking at alternatives, which obviously real estate is often described as, for that yield, for that security, is leading to some yield compression, certainly within our own long income portfolio. Literally not a day or 2 days go by without somebody making an approach for one of our long income assets at significant increases in value to what we currently hold them at. And that's something I think that is being driven by the fact that there is this almost desperate search for yield. Our third D is discipline. I think that, we are as co-founders, co-owners of this business, we are aligned, and that with our shareholders perfectly, and that will continue to impact our decision making. We pride ourselves on our process, our rationality, and the discipline of how we make decisions and how we allocate capital. Because, as I said, we're shareholders first, we're employees second. Today, urban logistics is our strongest conviction call because of the returns, the rental growth, the demand, the supply dynamics that comes with it. Long income, well-let long income in the right structurally supported sectors is our second conviction call, and that is where the focus of our capital going forward is going to be, and that will lead to further sales of non-core assets or assets that we think are not capable of meeting that criteria. And then the fourth D is dividend. We are continuing to generate reliable, repetitive, and growing income stream across our portfolio, and that is what supports our EPS growth. That in turn supports our DPS growth. The fact of the matter is we collect the rent and we want to pass it through to our shareholders just as quickly as possible after taking out the various expenses, etc. A long-term focus on dividend and dividend growth is what allows us to be able to aim for a covered and progressive dividend. And it's something that it's simple, it's a simple message, but it's something that we take very, very seriously. And we certainly take it more seriously than a lot of our competitors. It's amazing how many of our peers, at the first sign of disruption in COVID back in March last year, were very, very quick to cut their dividends, suspend their dividends, and it's no surprise that when they returned, they came back at different levels to where they were before they went into the COVID crisis. So I think that is that didn't apply to us. Our dividend progression has continued on unabated, and on the 25th of August we issued an announcement, showing with an RNS saying that our first quarterly dividend that will be paid in October will be 2.2 pence a quarter, which is nearly a 5% progression on where it was this time last year. And the fact of the matter is, we do believe that reliable, repetitive and growing income, if you can do that over a long period of time, the compounding impact on that is what effectively is the bedrock for your attractive returns that we hope to deliver to shareholders. So on that note, that's all from me. I'd like to thank you for your time and your interest in the company and also in the sector. And I wish you a good day. Thank you very much for listening. Take care.
Next up is a comfort break where we'll be showcasing one of our videos. Please enjoy, and we'll see you back right afterwards.